The question on everyone's mind these days is whether the markets are overvalued or not. Currently, the market has temporarily pulled back and investors' fears are rising that it may collapse, taking the market down. Hey guys, welcome to yet another exciting video. Before we begin, don't forget to subscribe to our channel and turn on the post notifications so that you never miss out on any of our upcoming exciting content. All stock market investors acknowledge that markets go through periods of euphoria and panic. During periods of joy, investors keep on purchasing shares, expecting a higher payoff. In a more technical way, this is the situation wherein the entire market becomes overvalued. The opposite also occurs when fear grips the market. Everybody starts selling their shares and the market becomes undervalued. Stocks with a more excellent market value than their intrinsic value or worth are supposed to be overvalued stocks. Intrinsic value is a company's original value that primarily depends on factors in its control. Therefore, the factors which influence a company's stock prices are referred to as external factors. It involves a rise and fall in demand of shares, market fluctuations, unfounded decisions made by investors which inflate the prices of such stocks. Other than that, stocks can also be overvalued if a company suffers any financial or fundamental crisis, in which case is overrated due to its internal factors. Several market experts oppose the concept of incorrect valuation of stocks, undervaluation, and overvaluation. However, several famous market mentors such as Warren Buffett and Benjamin Graham have applied the practice of value investing, that is, investment in undervalued or overvalued shares. If the market is overvalued, analysts often come up with theories that imply why this time it is different and why overvalued markets are going to be the new norm. Hence, if an investor can genuinely ascertain whether or not a particular market is overvalued, they have a definite edge over the others in the marketplace. Keeping an eye on several indicators is always good. There are different ways to find that the market is overvalued, so let's first take a look at the stock market to GDP ratio. This ratio is seldom referred to as the Buffett indicator. It is an exceptional way to check if the market is overvalued or undervalued related to its past historical average. If the indicator shows below 75, there is a tremendous value in the market, and it's undervalued. Normally, a value between 75 and 90 scores as fair, while 90 and above could mean being overvalued. As recently as June 4, 2021, the Indian markets hit 115%, the highest since 2008. Subsequently, the number has reduced a little, and today this figure stands at 104. This ratio is computed by dividing the total stock market capitalization by its gross domestic product and multiplying it by 100. So a simple calculation to do at your end. It's not usually a used indicator by many investors, but always good to keep an eye on. While this ratio is for assessing the stock market as a whole, let's take a look at two ratios that you can look at for individual stocks. The first comes price to book value per share. The calculation of price to book value per share is quite simple, and all you want is access to the company's current share price and their latest balance sheet. The price to book value is calculated by dividing the share's current price by the book value per share. If you want to determine the book value per share, you divide the book value by the number of claims floating in the market. Traditionally, a fair price to book value in a market used to be 3 and below. Today, you'll probably find it hard to find a share with that number, taking an example of Tesla in the US, which is possibly a little above 25. Facebook may be trading with a number closer to 10. This variable has also some flaws, and many experts will tell you that this has to be seen in connection with many other factors before choosing your strategy. Investors find the P/B ratio helpful because the book value of equity provides a comparatively stable and intuitive metric that can easily compare to the market price. The P/B ratio can also exist in firms with positive book values and negative earnings, since negative earnings render price to earnings ratios useless. There are several companies with negative book values than companies with negative yields. However, when accounting standards applied by firms, P/B ratios may not be comparable, especially for companies from different countries. Additionally, P/B ratios can be less advantageous for service and information technology companies with little tangible assets on their balance sheet. Other potential problems in using the P/B ratio stem from the fact that any number of scenarios, such as recent acquisitions, recent write-offs, can distort the book value figure in the equation. In searching for undervalued stocks, investors should consider multiple valuation measures to complement the P/B ratio. The next comes the P/E ratio. It is often said that anything more than 10 is expensive. One of the best ways of recognizing an overvalued market is by studying the price-to-earnings ratio of the market as a whole. This ratio is determined the same way as it is estimated for one individual stock. This figure is readily available in the marketplace as several analysts use it to evaluate the economy. A weighted average of the price-earnings ratio of the companies that make up the index is used to determine the price-earnings index of the whole market. Generally, the price-earnings index remains stable around the mean. This means that if you calculate the price-earnings ratio based on historical values, the average is the normal price-earnings ratio. Hence, if the current PE is much greater than the historical average, the market is overvalued. This is accurately what happened in the case of the Great Depression, the dot-com bubble, and the Great Recession of 2008. The total market capitalization to GDP ratio is the second and most important indicator of identifying an overvalued market. Under normal circumstances, market capitalization is almost equal to the GDP. If the ratio drops below 0.7 or so, it could mean that the market is undervalued and could present a great buying opportunity. On the other hand, if this ratio surpasses above 1.25, the market is overvalued. The difficulty is that the numbers needed to calculate this ratio are not available to common people. However, there's a workaround. Organizations like the World Bank keep on declaring this data every quarter. This number does not vary too much every day, hence a quarterly frequency is not good enough. Subsequently, with the technology firms coming in and ruling the roost, 10 just seems like a woefully conservative number. It can be calculated by taking the current share price and dividing it by the EPS or earnings per share. Again, taking an example of some global companies, Facebook currently has a PE ratio of 29 and Tesla has one of 624. It is also important for investors to determine whether the stock market is specific and the economy in general would observe any significant cyclical fluctuations which will affect the prices of stocks. In such cases, the stock prices of companies belonging to specific industries surges during an economic expansion, resulting in rapid capital appreciation and high dividends. This phenomenon, where economic expansion causes prices of stocks to grow, is referred to as a value trap because investors decide to purchase these stocks observing a spike in stock prices, but later are trapped as such prices fall incredibly and no one is willing to purchase it. So, who and why should we invest in overvalued stocks? Individuals who have plentiful expertise in the stock market or adept with its know-hows can choose to invest in an overvalued stock. It's because these investors possess profound knowledge and would be subjected to more certainty regarding whether a stock is undervalued or not. New or amateur investors would struggle to curate, research, and compute conclusive data, which would enable them to make an informed decision. However, inexperienced investors can also use the relative dividend yield percentage to decide if a share is undervalued. In addition to experience and inexperience, those individuals who previously hold overvalued stocks purchased before such inflation can also trade those during overvaluation to get substantially high capital gains. Even though we say that there are definitely many advantages to overvalued shares, the best overvalued stocks only hold one essential advantage. If an investor has been in the market for an extended period and previously held shares that have been overvalued due to a mistaken economic expansion, they can take absolute advantage of it by selling their shares. At the same time, if we look at the disadvantages of overvalued shares, they are being caught in a value trap by which an investor might incur considerable losses. To conclude, it takes a little bit of knowledge and expertise to spot and base your bets on an overvalued stock. While going for such a stock, assure that you have analyzed the business properly for its fundamentals and growth potential. Thank you for watching this video, and as always, subscribe, ring the bell icon, and check out our channel for more such videos. Make sure to put your valuable feedback in the comment section below. Until then, bye!